Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the median inflation rate across the globe. We'll focus on inflation in the US and China. We'll look at leading indicators for inflation in the US and why we expect that inflation will shortly start to pick up. And we'll also look at a leading indicator for economic activity in China and why we expect that economic activity in China is likely to shortly accelerate. And finally, we'll have a look at the labor situation in South Africa. We're going to start off with the global median inflation rate. So far, 38 of the 50 largest economies have reported inflation for last month. The median inflation rate across the globe has declined from 2.4% down to 2.3%. So backward looking, there's very little reason for concern on the global inflation print. And similarly, if you look at the US, inflation also declined there from 2.4 down to 2.3%. And again, backward looking, you would say, well, inflation is heading closer to the central bank target. There's little reason for concern. However, we can't simply look backwards. We need to try to estimate what's likely to occur going forward. And in the current environment, that's very difficult, especially when it comes to inflation, given the huge trade policy uncertainty, and we don't know where tariffs are likely to be within the next month, within the next 2 months. And that makes forecasting inflation at this point in time particularly difficult. And it's a difficult exercise at the best of times. So what we can do is a scenario analysis. And if we, at the moment, very simplistically assume that monthly inflation going forward is going to be about 0.2%, and that's in line with what it was last month. It's also roughly in line with the 15-year median. So it's a very simplistic assumption, and it could well be a different number than that. But to get a baseline forecast, let's for the moment assume that monthly inflation is going to be 0.2%. In that environment, inflation actually starts to accelerate from as soon as next month. Now, if we disaggregate the inflation print, we can look at shelter inflation, which declined down to 4% and it continues to head in the right direction. And you can look at inflation for everything that's not shelter, and that's down at 1.4%. Now, the Fed, simply looking at this, would be quite pleased. Shelter continues to head in the right direction, and inflation for everything else is well below 2%. And that suggests if we're simply patient enough, we'll land up with inflation being below 2%. But, and there's a fairly big but at this point in time, a lot of the decline in inflation and a lot of the reason why inflation ex shelter is below 2% is due to fuel prices. The average gasoline price in the US last month was about 13% lower at the same time the year before. And that helped to bring down inflation and helps to bring down inflation ex shelter. Now, the difficulty is from around about this time last year, the fuel price started to decline. And what that means is if fuel prices don't change from where they are now, by around about November, we'll actually be looking at a year-on-year increase in the gasoline price. Put in another way, we need crude prices to continue to fall for year-on-year inflation for the gasoline price in the US to continue to be negative and for it to continue to act as a disinflationary force. And in the basic assumption that fuel prices remain where they are now, within a few months, we will actually see fuel prices adding to inflation rather than detracting. And that's another reason to expect that inflation in the US is likely to tick up. The third reason comes from a leading indicator, and this comes from the services PMI series, where they ask companies around the prices that they've paid. And we can see from the latest data that that series has shot up. And typically there's about a 4-month lag between increases in this series and increases in inflation. So there's 3 key reasons to expect that US inflation is likely to pick up over the near term. We've got base effects, which in effect is what drives inflation picking up, even if month-on-month inflation remains at 0.2%. We've got a fuel price issue, which is likely to lead to higher inflation within the next 5 to 6 months. And in addition to that, there's a key leading indicator suggesting that inflation is going to pick up as well. So all told, reason for the Fed to be cautious for certainly the near term, and they're likely to want to get a good handle on where they think inflation is going to settle before they'll be comfortable with cutting rates. If you switch to China, Chinese inflation remains very low at minus 0.11%, well below the central bank target. And there is still ample scope as a result for monetary stimulus in China. We've recently seen rate cuts. It could well be the case that we see more given very low inflation. And in addition to that, total social finance, which is a key leading indicator for the Chinese economy, is up around 50% year on year. Specifically, the 3-month average is up around 50% year on year. And that's close to the strongest growth rate we've seen in the past 4 years. And there's about a 9-month lag between changes in this series and an uptick in economic activity. So this series is suggesting quite firmly that Chinese economic activity is likely to accelerate over the coming 9 months or so. And if we take a step back, we've got a broad mix of surprises on the economic front and on the inflation front across the globe. If, for example, you look at the US, what we've seen lately is that the economic data has been surprising on the downside, even though earnings has been good. Earnings growth is up around about 13% year on year in the US. Close to 75% of companies have seen earnings surprise on the bottom line. It's been a great reporting season. But despite that, the economic data has actually recently surprised on the downside, and inflation has surprised on the downside too. And that's typically an environment that would see a central bank looking to cut. It's difficult at the moment given how uncertain the outlook is going forward and the upside risk to inflation going forward. So even though the recent numbers are surprised on the downside, the outlook is looking quite questionable in the US. Japan, in contrast, is in an environment where inflation has been surprising on the upside, but growth has been surprising on the downside. Makes it very difficult for the central bank to act there, because with these two conflicting responses, given the weakness that we've seen coming out of Japan's economy of late, it's unlikely that the central bank is going to be looking to hike anytime soon. And then you've got Europe, which is in a combination of economic growth surprising on the upside and inflation surprising on the upside. And then the UK with economic surprises on the upside, along with China, and inflation surprising on the downside, the best combination, and an environment which is likely to be quite supportive for the economy and for risk assets. Finally, in South Africa, the labour data came out last week. It wasn't particularly encouraging. We saw quite sizable decline in employment in Q1, which is a leading indicator to suggest that the Q1 GDP growth number is unlikely to be good. There was slight growth year on year, but it just emphasizes key risks in the SA economy and why it's so urgent to get business confidence up so that we can continue to see some form of job growth with all the other benefits that come from that in SA. And that's where we're going to leave it for this week. That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider.